YouTube. I'll be using the board tonight. So I want to make sure that you guys can see it. So I flipped my phone around on Instagram, guys. So if you ask questions, I won't be able to see them. Head over to YouTube on my YouTube channel, or either on LinkedIn and ask me those questions, or send me a DM with your questions and I'll answer them after the live. But I want you to be able to see my writing, because when I turn it the other way, you can't see my writing. So hello. Let's see here. Wipe off my camera. You guys see me? So tonight we're going to be going over why you shouldn't use the bank to buy property, especially if you're investing in property. And for all my brokers, real estate agents, and wholesalers, or people that are helping people buy homes, you want to definitely tune in and probably save this, because this is going to be a game changer when you guys start looking at other alternatives and getting creative. So on Monday, we talked about creative financing. I went through a lot of details. Give me just one second. Let me adjust something. Let me go closer. All right, so we went through on there you go, on Monday about creative financing. Let me make sure Instagram can still see. All right, yep. So we went through creative financing, all the different types of creative financing. So what I'm going to talk to you tonight is I'm going to break down for you guys what seller financing is. That was one of the first ones that we talked about. So we're going to talk about seller financing, what it means, and more in depth, and then ways that you can use seller financing or owner financing to acquire property. Again, we're in a market now where the interest rates are super expensive. And so not only if you're looking for, if a buyer is looking for a home, even the ones that, even investors, is getting tough, because although rental rates are up, with the interest rates also going up, it makes it very tough to do what we call create cash flow, which is the difference between your loan payments or all your expenses, right? And then the income that's coming in. So if you have more expenses, or just the same amount of expenses that are coming in from your rental property, then you're not going to be making a lot of money, or you're not going to generate cash flow. So let's talk about owner financing. We want to talk. I have a couple of different topics I want to go into. Again, if you have questions, just let me know. I will get those answered for you. Okay. All right. So first thing is, what do we need to know about seller financing? So first things first is, on seller financing, the number one question I get asked is, do I have to have any money? You like cash money? You don't in some cases, and it really depends on the rapport you built if you're working directly with the seller. But in most cases, such as 98% of the time, you're going to have some type of cash, just like you would for a house that you're buying with the bank. You're going to need some type of down payment. So the down payment would go towards a percentage towards the seller. And then if you needed to pay fees like commission fees or wholesale fees or whatever fees for someone to bring you that type of deal structure, you're going to have to pay them cash up front, right? Because they're helping you get into a house. So do you need money? Yes. Most of the time, unless you're working directly with the seller, you built up rapport with the seller, you're going to need cash. And it really depends on how you structure the deal. It may be 5%, 10%, 20%, 25%. It really just depends on the type of deal. But yes, you will need upfront cash to go towards the down payment, which means paying out the seller, paying out any other individuals that brought you the deal, such as a realtor or a wholesaler. Okay, so down payment, you definitely need that. And the other thing you want to look at is your monthly payments. So typically, in generally, those payments are going to be higher right? Because when you're doing owner financing, you're not using the same type of underwriting that institutional banks are using or either government guidelines require. So because of that, and because technically it's a little bit riskier, right? You're going to see higher monthly payments. Now, typically these monthly payments are going to go in line with whatever the current rent rate is. But you still need to plan for your payments. So if you're already paying $2,000 in rent and you're looking to buy a house, just consider and you want to buy something that's owner finance or seller finance. This is just for your retail buyers. You want to make sure that you can work out a deal where you still keep your payments that you could afford at your rental property the same as your monthly payments for the owner finance deal or the seller finance deal. And then if you are an investor that is looking to get into an owner finance situation, you want to make sure that what you can charge as rent rates, that you still could cash flow what you owe to the seller. So for instance, if the seller requires a monthly payment of $500 a month and the rental rates is $1,000 a month, then given all your expenses, you can make money because you can make the difference in the middle. So you want to make sure that whatever that payment is, that it covers all of your expenses, that it covers everything, that once all the inflows are done for that month, that you still are able to cash flow. All right. And then balloons. We're going to go over balloon payments. So balloons are basically it's different from an ARM, which is an adjustable rate, which means the rate increases over a period of time. It stays usually fixed for the first maybe 10 years or so, and then it increases over the next few years. A balloon payment is the rate will stay fixed, but essentially they're going to call the loan due at a certain time. And that time can be 3 years, 5 years, 7 years, 10 years. Now, the reasoning behind this is because they don't want to be in an owner. Most sellers or owners don't want to be in a seller financing situations for long periods of times. They want to do it as a solution to something in the short term. So if you find a seller that requires a balloon, they're doing this because they're under the impression that interest rates in the market will go down and you can refinance and carry and have that note carried with a lender, like an institutional bank, once rates go down a little bit or stabilize, or you're able to buy it outright cash if you somehow come across some money. So they just want to be able to take themselves out of the equation in that period of time. So they would set those balloons to be due. And sometimes if you get a really good deal and you've built up equity, you can just take that equity, like refinance, take that equity and pay them out. So that is what a balloon is. So we're going to go over those a little bit more in detail about when to use, what you need to know about owner financing. So again, if you didn't get to see Monday's live, you want to start looking at owner finance opportunities. And this goes for, again, my realtors, brokers, and buyers. If you're having a tough time getting qualified to buy a home or getting pre-approved to buy a home, you may want to start looking at some creative ways to get into homes. Even some of the houses that have been on the MLS for a few months that have not sold, you want to ask your realtor, hey, do you think we can consider an owner finance situation? Here's the deal. This is my credit score. I haven't been evicted in the last 2 or 3 years, or no eviction is better, but at least the last 2 or 3 years, no foreclosures. I haven't, I'm not going through a bankruptcy. My credit is good. My DTI is high. I can't get approved for the home that I want. Do you think we can talk to them about an owner finance situation? And so what you also need to know when you're looking at that is you want to ask, if you don't know how to do this, you want to ask either your realtor, your broker, whoever's helping you. You want to ask them to pull the information on the property. So all the public information, you want to know when it was last sold and what they paid for it, if there's anything that is owed on the property. So what you want to do, the reason why you want that information It's because you want to understand how much equity they have in the property. So if they bought it for $100,000 and they still owe about, let's say, $65,000. However, right now the market says that it's worth about 150, then you know they have a lot of equity. You still have to satisfy, that equity piece. And I wanted to go back and say, when you're doing seller finance, though, if they still owe anything on it, that's considered technically a subject to existing financing. But if they pull it and it's 100% paid, free and clear, then you want to see what they what equity situation they're in. So if the house is worth 150, obviously it's 150 in equity, but how much money do they need up front, right? How much money do they need to walk to in order to create a structure like this? All right, so that is what you need to know. You want to know what equity position they have in the property, whether it's paid off free and clear. That's put you in an owner financing situation, or whether they still owe on it. It puts you in a sub to mortgage, is sub to the existing financing situation. And then once you do that, then you can start to work with your realtor. If they understand, ask them, do you understand what owner financing is, or subject or seller financing is? If they're really on it type of realtor, they will do the research and they will go and seek the information, because they can put together deals, because this happens all the time in like commercial settings, like commercial real estate. There's always, owner finance doesn't happen as much in the residential world, just because usually financing is readily available versus like in the commercial, where it's based on asset classes and things of that nature. So that is what you need to know about getting into seller financing. So just to recap, you want to make sure that you understand you want to make sure that you understand what down payment you want to get into. You want to understand what the monthly payments that you can afford on that property. And then you want to understand balloons, meaning what can I, based on my credit and where the market is, what can I negotiate with that owner as far as a balloon payment? Once the interest rate comes down, then I'll be able to build a little equity over time. I'll be able to get traditional financing or conventional financing. And it'll also lower your interest rate that you have with the seller, and possibly your payments, because you are able to get in at a lower rate in the future. All right, so that is what you need to know about seller financing. All right, next one is, let's dive deeper into terms. All right, and again, I hope you guys, if you have questions, hey Derek, if you have questions, put them on YouTube. Go over to my link in my bio. You're going to see YouTube Kelly Meade. Click on that. I'm going live right now on YouTube. Make sure you subscribe and follow me so you can get notifications when I'm going live on YouTube as well. But if you have questions about this on Instagram, again, I can't see the back of the phone because I want you guys to see the board here. But if you have questions, just simply go over to YouTube and put them in the chat box and I will answer them for you. All right, so let's talk about terms. So when you're structuring these deals, let's just say, let's skip past the dialogue, because I can go into another video about the dialogue that you would need to have, or your realtor or broker would need to have to start that conversation on owner finance, seller financing. That's a whole different, that's a whole different video, right? But what you need to understand before you start having before you start having that talk, is you want to understand how to structure these types of deals. Okay, I feel like I'm super dark. I want to make sure you guys are seeing me. Oh, come on. All right. Okay, so here are some terms. When we talk about terms, I don't mean vocabulary words. I mean, terms are, what are the terms and conditions of this agreement? What are we agreeing to on an owner finance, right? So when we just talked about earlier, we talked about We talked about interest rates, right? Because a lot of the reasons why we are in this, why we are presenting this type of offer is because the interest rates have risen. Let me go. I'm not that tall. Okay, so when we're talking about interest rates, a lot of people are like, what should I say that I can afford? Like, especially if the seller is not presenting it and you as the buyer is presenting it, then you have the opportunity to basically, come up with your own terms. All right. So right now, this video is in fall of 2022. So interest rates can be anywhere whenever you're viewing this. But typically, so right now, interest rates, if you have above like a 720, 700 credit score, they're 6.99% around about. Now that can change on a week's notice or in a month's notice. Okay. So typically when you're doing these type of deals, the thing about it is sometimes you could go up to that. But the reason why you're not able to get your DTI is because usually the interest rates based on what they're asking and where your payments will be means that it's too costly, right? So when we're looking at that, some savvy owners will probably want more because they're taking more of a risk, right? So they may want to do like a 1.25% more. So they may want to go up to like 8.25, right? In interest rates. But if it was me and I was the buyer, I'm always going to go on the low end. I want to go on where interest rates were great for me, right? I want to offer, maybe a 2.75 interest rate. Because if they do that, then you can also consider looking at a bigger down payment if they go with a lower interest rate. If they want a higher interest rate, then we'll have to adjust our down payment and save some of our cash, right? So this is some of the ways that you can play with the interest rate. Just how the interest rates work. Obviously, the more the interest rate, the higher the payment, right? So if interest rates are up, payments are up, right? So the higher the interest rates, the higher the payments, and especially over time, okay? So that is what the interest rates are. So if you are ever looking to figure out how you can, if you're trying to figure out what your payments need to be, the first thing you need to look at is your interest rate. Now, if you can't adjust your interest rate down anymore to get it lower, then you want to adjust the price of the house, right? Or you want to extend it out. So the other part of it is how long do you want to keep it? So what's the term, right? Are you going to do 30 year? Let me go back. Are you going to do 15 year, 30 year? Or, I've seen some, not a lot, but I've heard of some being 50 year. A lot of commercial stuff is 50 year. And what this means is amortize, right? So how are we going to amortize it? That means what are the payments over a certain period of time? So if we're buying a car, in cars you have an option. You can do a 24 month, you can do a 36 month, 50 months, 72, 60 month. So, and although what happens with that is the longer you go out, the longer you want to borrow this and pay this money over time, guess what's going to happen? Your interest rate is going to go up. So when you're looking at how you create a structure, the longer you go out, the more than likely your interest rates are going to go up, or they're going to request that they go up. Are 50 years for commercial only? No. There are some situations where, people are getting into homes where they are not with seller financing for over 50 years. The thing about it is, and I can show you how the sellers can protect it, because if either one of you, the buyer or the seller, comes to their demise, you can still put that agreement in what they call a trust, and so that trust will still pay out on that. Okay. So when you amortize it, you can do a 15 year, 30 year, and a 50 year. Now, obviously the more you go, as you go down in payments, your payment will be higher, right? So usually if your payment is higher in 15 years, you're going to want to work out a lower interest rate. So those are some ways that you can figure it out. There are a lot of calculators. I built out a calculator. And if you guys want that calculator, I've never like posted it or anything. I'll give it to you for free. Just send me a text to my number is 205 I think it's 274-8447. Look at my bio. That's my number, my text number. Text me calculator and I'll send it over to you guys. And you can use that mortgage calculator to figure out what the payments will look like. And so when we're talking about interest rates and then we talk about terms, right? The other part of it is going to be what your, so we talked about down payment as well. Well, that's the other part. So down payment plays a part in it. So the other thing is if you want to get your payments lower, obviously you pay more down, but can I be honest with you? The more you pay down, it doesn't change your payments that much. The thing that's really going to drive what your payments are is going to be your interest rates and how long you have it amortized over. So if you can't figure those out, then the last resort I would say add more down payment to it, but it will only drop depending on how much you want to add. Like going from 15 to 20% doesn't change your payments that much. So if you're able to keep on hold to your liquid cash, I would say start with a lower down payment and try to figure out a lower interest rate versus a higher payment to get your payments to get your payments at a monthly that you want to be at. All right. And so just want to just say, if you're looking at this and you're looking at buying a home right now, or if you're a realtor that knows someone that is having trouble getting their buyers qualified, make sure you tag them, tell them to come into this conversation so that we can help you guys. All right. So that is what, so you have your down payment. These are the parts of, these are the really core parts of what makes up a loan payment, right? A loan structure. So down payment, interest rates, and then how long does it amortize? All right, those are the main things. And then your next one would be is your balloons. So balloon payments, it really depends. You don't have to use this structure. It's just another option if for some reason the owner wants a guarantee, right, that they will get paid over a certain period of time, even though it's going to still be amortized over 15 to 30 year or 50 year payment structures. They still want their full balance at a set amount of time. They don't want to wait until the full thing pays out, right? So you can do typically how I structure it is 3, 5, 10, 3, 5, 7, or 10-year increments where there's a balloon payment. And what that means that, let's just say you're in a 36 month, which is a 3-year. You pay that last payment, but then also in that same time, you call the loan due, meaning you pay the principal plus the interest, and you pay the interest that is amortized over whatever your terms were. So it's not the interest that you paid up until that point. You pay all the interest that was due in that 30 to 50 year time frame or 15-year time frame. You pay that plus the principal due. So you pay the full balance that was owed to the owner. After you subtract obviously the first 36 years, you pay the rest of that, basically the rest of it as if it was in the future. You pay that in the present. I hope that makes sense. So those are what a deal is made up on. So here's a question for you. So I have a question. So is it better to put down less money with a better interest rate? Yeah. I mean, yeah, if you already have if you put down less money with a better interest rate, and your payment still works, then you can do that. But if they want, let's just see this, if they're basically counter offering you on what the interest rate is because they want more money monthly, then you can always offer to pay more down payment. So at least they know they have more money in their pocket now if you offer them a better interest rate over time. Because especially if you're speaking in an investor, right? For investors, we look at things differently. A lot of times, like to put cash and stuff, we want to know how hard our cash can work for us. So if we can get into a really great deal for $30,000 up front, we don't mind what the payments look like on the back end as long as we are cash flowing positively. And so if you can structure it where you can pay the most down payment to get the lesser interest rate, I would say that's a better deal because now you're able to cash flow over time because you have a lower payment. And so yes, with good credit, but again, with seller financing, unless they have created their own set of qualifications, you can have horrible credit to get owner financing because the approval is based on the owner and the owner seller themselves. Now they can request for you to look into your credit report and they may see things that they just don't want to deal with. But when you're doing this, money usually talks. So if you have the cash and you can pay it, then usually that's all the approval process. There's no underwriting in this scenario. So this is so that is what the breakdown of what what owner financing, what just general what the deal structure. Now I can get into it a little more. So most lenders, they'll ask for you to pay certain points and things of that nature. A lot of times that's out of the window because sellers and owners, they don't need you to pay additional points. There's no additional fees that's associated with lending the money, is because they get all the down payment themselves. So there's usually no points associated with it. But if you want to get real savvy with it, you can add a point onto it as well. So that is what the deal structure. So let's just give an example, right? So here's a deal that I was actually looking at today, and it was a storage unit, and I sent over because what they were asking for and what the payments would be, it wouldn't make sense as an investment deal simply because the deal wouldn't cash flow. Like I wouldn't cash flow any money from it, right? And so what's the point of it with buying it? And it's a storage unit, so it's not like a home or anything. But let me grab this. Where I lost you guys. Hold on just 1 second. I'm trying to get you back on the screen. All right, here we go. So here are the specifics on this. So I looked at it a couple of different ways. So the storage unit, he's asking $275,000 for a storage unit. It has 23 bays in it. And they're all different. Like the profile is mixed, is different, so that he charges different rates for each bay, different types of bay. All right. And so the other thing is he gets about it's about, after you do all of your expenses, he nets about $20,000 a year, right? So that's about $1,800 a month. Is what he nets. That's the income that he generates each month. All right. So with that, when I did the breakdown, I said, "Wow, like I wouldn't cash flow anything because all of my money is tied up in, all of my money will be tied up in the loan payment that I would have to get to do this because the income doesn't make sense." And this is for an investment property. If you had a retail buyer that needed that was in that situation as well, you would look at it as, what is the current market rent rate in that area. If what they're paying to own a house is significantly higher than the actual rent rate, what's the benefit of them owning the property? What truly is the benefit of getting into that deal? Because they could just continue to wait and rent, right? until the interest rates come down. So that's the other talking point, that if you're not doing it as an investment, you're doing it as a retail. You want to look at, okay, I get that I can go and rent out a 3-bedroom, 2-bath house for $2,000, or I can buy one. Versus if I buy a 3-bedroom, 2-bath house, but I have to pay $3,500, I would rather just rent the $2,000 one, and I can leave when I want, and I'll just wait until the interest rate. So that's kind of the negotiation talk that you want to have on it. Give me just 1 second. I just want to check on my Instagram, people, make sure I'm still on there. Perfect. I'm still on. All right. So Instagram people, I have not forgot about y'all. I just want you guys to be able to see this. Okay. So with that being said, get my trusty calculator out. So yes, so that's net. So net what he makes is about 166 per month. All right. So when I ran my calculations on that, and I had like a 6% interest rate, because I start out with the market is, just around what a market is, just to see how good of a deal, how much of a win-win situation I can make this. So I started out at a 6% interest rate with a 15% down payment on the deal, right? And that's a down payment. And I amortize it over 30 years. So my payments will be as though they were for 30 years, but I put a 5-year balloon on it. I think interest rates will be lower by then, because I want to give myself an opportunity to get a lower interest rate, because if I start high and I can still afford it, then that means that when I refinance, right, into a lower interest rate, then I can usually have some equity, or at least or lower my payments, have equity plus a lower payment. So you're in a win-win situation when the market stabilizes itself. All right. So when I did that, let me just put in my little calculator right here. So when I did that over a 15% down payment, so what I found is, so when I did that 15% down payment, by the way, guys, is $41,000. So that's always a good thing when sellers see that, because typically that goes to the bank, right? When they know that at least that goes into their pocket, they always get a little bit excited for it. And then the other part won't be taxed over time. So they'll have this as capital gains, that's taxed, and then they can save on taxes for the rest, and they can have constant cash flow coming in at least for the next 36 months. So what my payment ended up being was $1,400. So that's just your loan payment. If for investors, you still have taxes, insurance, it's just that PITI. So you still have all of these, the rest to pay, plus, maintenance. If you have someone on site, you got to pay staff. Like, it just wouldn't make sense, right? If it only generates this much in income, and this is what your loan payment would be, that wouldn't make sense, right? So what I did first was I said, okay, well, let me go ahead and lower the interest rate. So I crept down to the interest rate, and I went to a 4.25, right? And when I went to a 4.25, it gave me $1,149.91, which gives me just over about $500 in cash flow, which not bad. It gives you a little bit of wiggle room, but still, even with that, it puts you at a negative cap rate if you're going to look at cap rates. And this is for a whole nother different discussion. For cap rate, the cap rate is at a negative. It was like a negative 4.22. You want to always be in investment properties, especially in this market. You want to be in investment properties at about 8. 8 is healthy, 10 is better. So just to show you how an interest rate at just going down 1.75%, how much money you saved on payments. Let me give you a different scenario. Let's just go back and say that I wanted to pay more money down. Let's just say I want to do 20% down, but I'm going to leave it at the 6% interest rate. So this was at with a 15. This is at 15% down payment. Which equals the 41, right? Versus if I went, it would be 31901 at a 6% interest rate, but the down payment, it was a 20% down payment of $55,000, right? So I had to give up about $14,000 just to go down, not even $100 in a payment. So that's why I say try to adjust the interest rate first, because the interest that you have to pay on that money will significantly lower your payments versus paying more cash out of pocket. It just doesn't move the needle enough for you to get where you need to be. So if you're a realtor, especially a broker, you probably are like, what in the heck? I don't like to learn about, the mortgage and the financing, but I would say when you get into deal structuring and coming up with terms, definitely go through your brokerage, make sure that you have the right paperwork. But these are some ways that you can create a solution. Or if you don't want to do it, I'm pretty sure that there are companies that offer owner financing deals, and you can bring your buyers into these type of situations. But you still want to understand how all of this works so that you can give your buyers the best representation. All right. So that is the part of terms. Now let me go into closing. All right. So closing is actually, you'll probably love this, because typically when you're doing an owner financing situation, let me just say this, you typically don't need an appraisal, right? You don't, unless you want to pay your own appraisal. You can still write the contract out. The buyer can write the contract out as appraisal for an appraisal. What I've seen is most buyers don't really don't opt to have an appraisal. The only reason they have to have one is because they're going through conventional financing, and the banking institution or the lending institution needs to have that appraisal to make sure that the property is worth what they say it's worth, because they use that as collateral to obviously fund the deal. So typically you don't have to wait for an appraisal, or you don't have to go through like final inspections and things of that nature, unless you guys write something where you want to go through get the property inspected, so you know what you're getting yourself into, and then that the seller agrees to basically fix certain things in the house. But that's up to your discretion. And every deal is different. So typically there's no appraisals, but they can be. But if they are, they're hired by you. So the appraiser works for you now, and they don't work for any other institution. So you can usually have it back within in a quicker turnaround time. Okay. And then inspections is all up to you guys, whether you want to do as is or you do want to do inspections, but you won't have to have a lender inspection. So you won't require certain guidelines. It will be just an agreement between you and the seller for an inspection. So typically you don't have to have that if you're getting into a seller finance deal. And then the only thing, you can close quicker. So if you already have the cash, you can set the date to close whenever you want. It can be in 7 days, 10 days, because at this point it's just running the title search, which is typically 3 to 5 business days, sometimes 7 business days, and then bringing the cash to closing and having the contract there so that the closing agent and the attorney can go through and make sure that the HUD is properly prepared and everything is agreed on, and all the records, all deeds are going to be transferred properly, because you do get the deed to the property. And now the owner does not own that property anymore. They now become the bank. They basically have a lien against that property for the amount that you guys agreed to. All right. So that's the closing. So basically, the contract would look different. So if you are an agent or a broker, you want to make sure. Now, I use my own contracts, but you want to make sure that, especially if you're going through like an independent brokerage, you want to make sure that you have your qualifying broker review your contracts to make sure, or ask them if they have one, to make sure that you're using the right documentation so you can protect yourself and your buyer, and also the seller. Okay. And then you want to also, you still want to prepare an estimated closing statement so that both buyer and seller understands what each person is going to come to the table with, and so that there won't be any discrepancies. So you want to put those terms into that estimated closing statement. So you want to put the payment, the interest rates, the terms, who's going to pay what in closing. You want to have all that signed by both buyer and the seller so that everybody understands how this deal is going to be structured. Okay, so that's part of the closing. And then the biggest thing that I get asked is, okay, so let's just say we just closed on the property, everyone's happy. All right, we're at 24 months later, and now okay, before I go into that, so Derek, that's funny. Owner financing isn't a scam. I get a lot of people that when I present this to some owners, they're like, this sounds like a scam. And I'm like, there are so many people that have been doing this for decades, but it's about lack of education, right? Like when people don't know, they're just, people are ignorant to the things that they don't understand, because I didn't think it was felt too good to be true to me as well. But whenever contracts hold a lot of weight, we are in a suing country. I promise you, people will take your butt to court if you don't, if you fail to do, to perform on the contract, especially when you have them filed through an attorney's office and filed at the courthouse. So I would say, don't skip steps. Make sure that you have all your documentations and copies of everything. But no, owner financing is definitely not a scam, and it's a beautiful way to get into home ownership a lot quicker than going through credit repair and doing all these other things. Like, I'm not saying don't go through credit repair, but as you're doing it, you have the right to become a homeowner or an investor and own properties way before. All right, so in the closing phase, so again, we just closed on our home. We feel good, we're happy, and then now the buyer has missed 3 payments and the seller is starting to freak out. What happens next? Okay, so the first thing I would want to say is, especially if you're getting into this, and if it's your first one as a realtor, I would suggest you go through a service that's done this before, because they've already had these, what they call risk management procedures in place. You want to go to what they call a debt servicing company. What the debt servicing company now does is they are basically act as a project property manager, essentially. Because normally we make our mortgage payments to a bank when we log in online and we make them. But on this situation, you are going to have if the seller doesn't want to be the person that is handling all the payments and keeping track of that, they can hire a debt servicing company where the buyer will submit their payments, and when they're late, they'll get the notifications, they'll get all the the letters that were required by that state in order to proceed in what they call like a foreclosure. So what happens is the seller would essentially go through the process of a foreclosure, meaning that they can acquire the property back. And I always tell them, like, in this situation, although they don't want to go through another cycle of selling, but if you are able to get paid once on a house and then you made money while you in the meantime, and then you have an opportunity to get paid twice on the same house, like, to me that sounds like a great opportunity. But I get a lot of people are not into real estate like I am, so it doesn't feel the same. But what the debt servicing company does is they go ahead and they start that process for you. And if the buyer did miss the those payments, then they will step in and they will start the process to go through the courts and making sure, and then also foreclosing and having the county basically remove the person from the property. And they will also go through, communicate with that person on next steps, so you don't have to. Now, if you go through a company that does this as their business, they're going to have all of that in place for you, and you never have to worry about that part. So I would say, especially if you are a seller, a realtor that is representing a seller, you want to make sure that you have that conversation with the seller, because that is the biggest part. Is, what if they stop paying me? What do I do? And the title is transferred from me. I can't just kick them out or evict them because they're not a renter, they're an owner. So what do I do? And then that is what you do. You want to go to a debt servicing company that handles these type of things, and then they will go through the court process to get them out. And it will still feel the same as a regular foreclosure. It may take months, because they have to they have to go through the announcements in the newspapers and all of these great things. And you have the opportunity to put it back on the market, put it up for auction off. You have the opportunity to do a lot of different things as a seller. The other thing that you can do is do a land contract. So that's very popular when you're doing owner financing. So when you do the land contract, basically it says that the title transfer over to this person as long as they're living, which is also great, because if something happened to them and they hadn't finished paying, then the deed would transfer back to you. But the land contract, and we can go into a different, like a separate video about this, but what the land contract does is it basically gives the seller some ability to, that if they need to take the property back and acquire it back, they can do so through the courts, because they technically still own the general deed, and the person that's living in there only has the land deed. So if they need to acquire the property back, they don't have to go through a lengthy foreclosure process, right? Because the land contract will stipulate what the contract means, meaning that if they stop paying this, then they have defaulted on that contract, meaning that the deed automatically gets transferred back to me. You do have to go through court. You do have to go through that entire process, but it's a lot quicker and it's a lot smoother than going through a traditional foreclosure process. Okay. Have some more questions. So is it, oh gosh, yeah, they can be really, really crazy. Okay, so we went through the closing. So now we know that first you want to have all the proper contracts in place when you're doing the seller financing. Again, I have contracts where it's specifically for subject to financing, owner financing, laying out the terms, laying out the conditions before we go, and what the earnest money is, and all of that great stuff, what the terms of the loan would be. And what the conditions of selling their property, like any inspections or appraisals if they want to order their own. So it has that in the contract. You want to make sure you have your own and it's approved by your brokerage if you're a realtor. And if you're going to use a company that does this, just ask them for theirs. Just say, I'll write it on yours, and because I want you guys to service this note, right? After my client would like for you to service this note once it's done. And we'll talk a little bit about that in just a few minutes. And then we went through title. So again, title search, 3 to 5 business days, and you can usually close an owner finance deal within 10 to 15 business days, or in 5 to 7 days if you already have, if the buyer already has the money readily available. And then default and protection, again, you can go through a debt servicing company and they will handle all this for you, just like a property management company will handle a tenant. debt servicing company manages the buyer, making sure that they are paying on time. And if there's any late fees, that like if they pay after the time that mortgage was due, they'll assess late fees and all that stuff. Okay. Then the other way to do it is to do a land contract. Land contract is probably the most popular way that a lot of people do it, just because it protects the seller, that if the buyer defaults on their agreement on the loan, then the seller can then go to court and take their property back without going through a lengthy foreclosure process. Okay, so that is what closing is. So next, I just mentioned it. So sellers would usually ask, well, what if I don't want to hold it for 33 years? What if I kind of want to be done with this, sooner than later. But again, they're somewhat in a distressed state, because we're going to be targeting houses that have been listed on the MLS for an extended period of time, over days on market, or had expired or canceled listings. We're going to be targeting those type of homeowners, because yes, they want to sell it, but maybe it's just set on the market so long and they thought maybe now is just not the right time. I'll just have to figure out something later. So what you want to do next is you want to look at exit strategies for your seller. As a good realtor, you always want to provide your seller with the best resources. So if you are able to work them through this deal and get them to say yes and agree to this deal, then let's talk about how they can exit from it. So again, that debt servicing company, all they do is service notes. I don't know if anyone has ever heard of the terminology of a note buyer. So a way to get into real estate and never actually owning any real estate, but still collecting all of the debt that is associated with real estate, is called being a note buyer. So that's essentially what banks do, especially if you've ever been approved by a local bank. Like my very first fix and flip, I was approved by a local bank. It was a credit union. And then I got a note within 90 days or so, maybe even less, that my loan had been sold to Wells Fargo, because that's what they do. The smaller banks will get you underwritten. They usually are very member friendly, but they still have certain guidelines that they have to go under. And it's mainly because they are getting your package ready. They're going to throw you in a pile of several of other homeowners that they have those that they carry those loans with. And then they're going to sell it to the big boys, right? And then those big boys are going to package those up into a bigger pile. Then they're going to sell it to the bigger boys. And that's how it all works. Like your loan gets sold throughout it. And that's so these banks, the bigger banks, are essentially note buyers. And so that same concept works on a smaller scale with individual buyers. So if you never want to own a piece of real estate, but you want to collect debt on it, you can be a note buyer. And what that means is, if there is a seller that has a buyer in the property and is stabilized, they've been making payments, but they want their cash out, right? They want the lien that was promised on that property. They want it cashed out and they want to move on, right? They don't want to carry the note for the particular property anymore. Well, there's a note buyer that will come in, evaluate the deal, look at it and see, because they're going to want to know the predictability of the person defaulting on the loan. They actually make more money when the person defaults on the loan, but they're going to look at the predictability of if the person would default on that note. And then they have their own algorithms, and then they make a decision whether they want to buy the note or not. And so if they buy the note, they basically pay out whatever you have left in payments. So you still get to keep your down payment on properties and all your other payments. They take over, they buy out, sometimes at a percentage, a little like a discounted rate, the amount that's left on the loan, and they cash you out, and then they come into your place. And so now the note buyer, is in the seller's place. The seller has their money cashed out, and then the note buyer services that note now. So they bought it out. And what these note buyers also do, they work like small banks. What they do is, after they collect a certain amount of notes across the US, then they're going to package it up and they're going to take it to a broker, and a broker is going to then sell it to a big bank. So that's how it all works. So when I hear that it's a scam, the fact that there's a whole entire industry and a whole entire business that is around, especially buying people's notes, like they're like just explain to them how that process works so they understand like this is not a scam. This is actually a big business. Like mortgage industry is a huge business, not just for the banks, but for savvy investors as well. So I have a question. The question is about refinancing. Why when you refinance the same mortgage company, they do another title search and charge you? Like, what do they expect to have changed? It could be a lot that actually has changed. So it protects them because you could have gotten married and added someone to the title. There could be liens on the property, mechanics liens with a tax lien. There could be all kind of things that have changed with the property when you refinance. You can only imagine. There could be a property that is held as collateral that has loans against it. You might have had another HELOC. Like it could be a lot of things that's going on with that property. And so they're going to do another title search to make sure that the property is still in what they consider a stabilized condition so that they can actually lend to or loan that property out. And typically what happens, like if there are some liens or anything, they'll still, if you're doing a refinance, they'll still refinance that, but then you'll require you to satisfy that amount before they refinance it. Because they're going to want a clear title. Because what happens is if for some reason they ever have to foreclose on you, if someone is in a position where they can take claim to some of the collateral or the equity is associated with their property, it puts them in a weaker state of collecting their full amount because they would have loaned you. Let's just say you had $100,000 in equity and they give you a line of credit. Let's just say they gave you 75% of that for $75,000, but then Joe Smo over here put a mechanics lien on you or some other type of liens that all come up to $30,000. Well, those people have to get paid usually as well, and so it puts the property in an upside down state now if they have to pay out more than just them as in first position. I hope that makes sense. So been going pretty strong here. You're welcome. You're welcome. Yeah, we've been going strong. I hope you guys have a better understanding of what seller financing is. I want to start tomorrow. We're going to go into another class, and on Friday, I want to make sure that you guys understand how to start looking at some of these deals differently. Because the market, just because interest rates are up, the buyers are less on the market because they're buyers that only know and also realtors that only can help buyers buy one way. When you start to learn how to buy several different ways, then you see that your opportunities really open up. That's why I never get concerned about what the market is doing. I love when more people think it's scary. It's kind of like people that's in stock markets, and I don't understand the stock, but people love when people start leaving the stock market because now it gives them an opportunity to buy and be creative in how they buy those stocks. Same thing with real estate. When people start leaving the market and now we get to take our pick, we start to get creative in how we can structure deals, right? So again, let me know if you guys have any questions. I'm going to leave this up for about 24 hours. But drop me a DM if you want the calculator. I can send it over to you and get you squared away. All right, guys. And then also check out my link in my bio. If you are a realtor that is looking to learn about this, you want to learn how to work with other individuals in the real estate that can service you like wholesalers, or work with developers and builders, and how to build those strong buyers for builders and developers, or how to list builders and developers properties. I have an introductory course. It's just like a couple of bucks. Go in there, check it out, and then also stay tuned for my mentorship program, where I'm going to be teaching you guys how to do these deals, how to structure these deals, especially if you're a real estate agent. It'll be very helpful for you guys to understand in this market so that you do not get away with your listings. And let me add another tidbit. even if you do any of these deals is not listed on the MLS, you can still obviously add it to the MLS after it closes. Like you still get your recognitions for your deals closed. All right. So thank you guys. Have an amazing night. And again, DM me if you have any questions. I would do my best to answer you as quick as possible. Have a good night.